Welcome, everyone. Thank you for joining us today. Hopefully, it should be another interesting panel discussion. This time, we're focusing on the topic of the recent consultation launched by the FRC, outlining their proposed revisions to the UK Corporate Governance Code. We're going to discuss some key points around these proposed revisions, try to unpack what this might mean for UK businesses, how it might reshape corporate governance requirements in the future. You'll be pleased to know this is going to be a slide-free zone, so no PowerPoint presentations to run through. This is going to be purely discussion-led, which should help facilitate some sort of valuable real-world insights into this topic. And I'll be posing some questions to our panel of experts to help navigate the key areas of this subject matter and cover all the bases. In terms of timing, the session will run for approximately 40 to 45 minutes in total. We've allowed 5 to 10 minutes at the end to answer any questions that you may have on the topic, so feel free to post those throughout the session using the Q&A function available on the Zoom webinar platform, and we'll pick those up and address as many of them as we can at the end. But before we launch straight into the discussion itself, so let's begin with some brief introduction. So my name is Mark Jackson. I'm the practice lead for RM practice lead for Turnkey UK. So a big focus for my team is helping our customers to try and effectively manage their business risk and associated internal controls. Therefore, corporate governance requirements, such as those outlined by the code and the impact this has on how they demonstrate appropriate levels of governance over their risk and internal control frameworks is vitally important. I'm delighted to be joined today by Richard Anderson, who has a wealth of experience in UK boardrooms and advising on corporate governance matters generally, as well as Chris from Diligent, who will also be sharing his valuable insights on today's topic of discussion and what he's seeing with his customers and related challenges that they're facing. So I'll hand over to them both for a quick introduction at this point. Shall we start with yourself, Richard?
Yeah, sure. So Richard Anderson, I originally trained as a chartered accountant, but I'm nearly better. Thank you very much. I first got involved with the corporate governance malarkey back in the early 90s with when Cadbury was published and the Rutterman guidance on internal control, and I've been closely watching, initially advising companies as a partner from Coopers & Lybrand and PwC, and then subsequently over the last number of years as a board director, where I've both chaired companies, chaired risk committees, and sat on audit committees. And therefore have had even though they weren't necessarily required to comply with the code, had a very keen interest in developments as they've gone forward. Look forward to discussing the latest iteration.
Thanks, Richard. Chris?
Thanks, Richard, and thanks, Mark. Hi, everybody. So Chris Mills, I'm a regional director here at Diligent. I've been working in the governance, risk and compliance space for a few years now. Diligent as a business, as you will know, are at its heart a technology business. So I've been working with companies, certainly in particular over the last 12 months, around the corporate governance reforms, and where technology is actually able to support you on that journey, critically where it doesn't, where the human element has to come in, and helping a number of business across the UK on their journey to being somewhat compliant, albeit there is no silver bullet, and technology is not a silver bullet. So it's really interesting hearing how technology and people and knowledge can kind of interact with one another to come to a solution that actually meets the outcomes of what we're facing today. So pleasure to be here, and thanks very much.
Thanks, Chris, and great to have you both on board with us today. So let's launch straight into it then. So the first question I'd like to pose to the panel is, I think it's a good leveler. It helps to provide some context for anyone attending who is perhaps less familiar with previous events, and that is, why is the UK Corporate Governance Code being updated? Now, I guess we could go quite far back on this one when it comes to the true underlying reasons, and include a number of events if we were to link this with the UK audit and corporate governance reforms being addressed to some extent by legislation drafted by the UK government, the accounting scandals involving UK firms, which ultimately led to a number of reports being commissioned on a number of areas, including the FRC itself, audits of procurement and remuneration, competition within the statutory audit sector, and reports on audit quality as well. So it could be argued that the code is being revised to fill in some of the corporate governance related blanks which aren't being explicitly addressed by legislation. So these revisions are hoping to close the gap somewhat. But what would you say are some of the key underlying reasons why revisions of the code are being proposed at this point? Richard, should we start with you on that one?
I would probably go back in history to about the 17th century in terms of looking at reasons for corporate governance. But in terms of this particular iteration, I think you summarised very well the issues around audit and going concern and sustainability have all given rise to this latest iteration. Probably goes back to Carillion, I guess, as being one of the key drivers of this particular set of changes. There's a sense in which I get from it that the government has said, we are going to do these things. You need to make sure that you can, to the FRC, you need to be able to backfill to make sure that the corporate governance code fits. So a lot of the stuff around audit committees that we might talk about is really being dictated by the government's insistence on a new approach for PIEs. We will be, I think, seeing quite a few changes around that area, and I guess, you know, there's a small change around remuneration, which we'll no doubt touch on, which is very much around the, you know, you shouldn't be rewarded for failure, a very strong theme from government at the moment. So I don't think there's, you know, it's not as if this is a big iteration. It's a number of very small bits around the edges and a biggish bit around the audit and risk management and internal control area.
So do you think that where the UK government have not felt that they can or should apply or enforce things through legislation, then they're just putting this bit of extra pressure on the FRC to, like, say, backfill and fill in those blanks?
Oh, it's interesting to me. There's a certain degree of duplication. I think the government's proposals for the triennial audit and assurance policy and for audit committees has come out very recently. And it seems to me that the question that the FRC is answering is, if that's relevant for those with more than 750 employees and 750 million turnover, why isn't it also relevant to anybody else with premium listing? And actually, I then go on to say, if it's relevant for anybody with a premium listing, why isn't it good and better or best practice, or at least better practice, for any other organisation that follows the corporate governance code, including a lot of government entities?
Chris, any further thoughts on that?
Well, I think Richard's last point there is a really interesting one. Is we've obviously got the rules about who this officially kind of applies to, but certainly the conversations that I've been having, you have a conversation with a business and they say, well, it's not applicable to us, so we're not actually concerned. Then you speak to other businesses and they say the opposite, is it's not applicable to us yet, but it just feels like the right thing to do. So there is certainly a balancing act there between, you know, understanding that it might not be applicable to you today in terms of any kind of requirement, but it's something that it should be best practice, and it is a way in which for you to build resiliency into your organization. There's a big difference, and we've seen it from Carillion and from others in appearing resilient versus being resilient. And why should resilient only really apply to, as Richard says, those premium listed businesses? It's something, and it's a movement that everybody should really be focused on, especially in the times that we're seeing today economically.
Two quick follow-ons. I used the acronym PIE, Public Interest Entity, for those who aren't sure. I had a senior moment and I couldn't think what it was as I was saying it, and then it came to me. So I've just come back on that. Second thing is this business about others who claim to be following it, or who say it's their preference to follow it, needs to be very careful, or indeed so do those who don't, because it could potentially be held up in court as being the best example of how corporate governance should work.
Okay, interesting. Okay, so for our next question, so let's get into, I guess, the finer details regarding the actual changes being proposed with this latest revision. Now, there's quite a few revisions mentioned within the consultation paper itself, ranging from kind of strengthening board accountability over risk management, internal controls, that's being sort of the big piece, let's say, wider responsibilities over ESG reporting and assurance, to things like further supporting diversity of skills and experience on UK boards and board performance reporting, etc. So let's start with you again, Richard. What do you see as some of the key changes being proposed to the principles and provisions within the code? How do they relate back to the UK audit and corporate governance reforms?
So what's key and what's interesting may be slightly divergent. I mean, I think it's really interesting and actually obtusely important that under the reporting under board leadership and company purpose, the requirement is that when you're reporting on your corporate governance activities, you have to focus on activities and outcomes rather than simple boilerplate. I mean, it's never supposed to be boilerplate, but it often is.
Yeah.
And of course, as my other half is sweating it out in Greece at the moment, there's going to be more focus on climate ambitions and transition planning. As a director, I'm really interested in the risks of overboarding, and I personally don't want to overboard, but there's going to be a lot more focus on that. But the really big areas, audit risk and internal control. So, you know, there's going to be the requirement for an audit and assurance policy for these public interest entities. They're going to have to follow this new audit committee and external minimum standard, where this strange requirement to it becomes almost a duty on the audit committee and the boards to make sure there's sufficient competitors to be able to fulfill your assurance requirements. That's totally backwards. It's not a monopsony that's doing all of the purchasing. It's a highly competitive market. And the suggestion that audit and risk audit committees should take on responsibility unless some other committee is allocated it for sustainability reporting. I suspect the bit where there could be the most frenzied activity is around the effectiveness of internal control. Very much focusing on the importance that this isn't a one-off at one time exercise, but it's an annual commitment that you need to monitor throughout the year, and you need to provide the basis of your statement. Now, how on earth are organizations going to do that? And I have no doubt that Chris and Mark have plenty of words to say on that subject. But as a board director, it always troubles me as to how we're getting the assurance to be able to make those statements. We're still waiting for updated guidance on risk management and internal control, etc. But this is a really meaningful, meaty issue, and it shows the evolution of governance over the years. If you go back to some of you may be old enough like me to remember the Turnbull guidance on risk management and internal control. Turnbull always said for goodness sake, this is merely a conversation around the board table for an hour or two, a couple of times a year, to we're now being expected to report on the effectiveness of internal control on an ongoing basis. That is going to involve a lot more than a chat round the boardroom table, which is a substantive and substantial change to the code. And there will be a lot of resistance on the part of companies from spending too much money on it.
Yeah, that's good. But I think you've hit one of the key points there. Chris, I don't know if you want to take up that point a bit further.
Well, I think, thank you, Richard, and thanks, Mark. I think that's pretty critical. And certainly from the conversations that we've had with companies, trying to understand the best way to tackle that, because there's kind of two elements to it. It requires some senior stakeholder engagement. It requires operational teams to also be providing information back and forth with those senior stakeholders. And ultimately it puts, as Richard points out, I want to say pressure on directors of a business and on the board and on the committees to actually make a statement on the effectiveness of those controls on an ongoing basis. That is quite a significant change. Of course it is. But in order for that to be done with confidence and done seamlessly, then there has to be working groups involved. There've got to be steering groups involved. You have to engage at so many different levels of the organization in which to actually identify what is the key pieces of information. How do we present that? How do we remediate any issues? How do we fundamentally take hold of this process so that directors can make that statement with confidence and are not putting the business at risk as a result? It's not an easy thing to do. We've worked with many businesses who are trying to do it, as Mark has as well, as I'm sure Richard has as well. And there is no silver bullet, as I mentioned earlier on, but there are ways and means in which to alleviate that. But it can't be done in isolation. If you create silos throughout this process, then you're not going to actually present that resilience that you think you might be presenting. Rather, it's more of a showpiece. It has to be an egos out the door, non-siloed conversation in order to actually create the improvement and change management that's required for something like this, which is not, as I say, an easy thing to do at all.
No, absolutely, and that's where you have to apply that real structure and purpose. And there's teams with proper governance responsibilities across the three lines of defence, from management to those sort of compliance teams and through to internal audit as well. And they've all got their role to play within that in terms of demonstrating effectiveness over internal control. It's leaning towards the US SOC style of proving it's without it, with the added flexibility, I guess, that the UK Corporate Governance Code will allow, because they know there's the terms like proportionality, etc. The good thing is that hopefully organisations can take it in that spirit, that they'll employ the right methods, the right procedures, but do it in a way that isn't going to cost them the earth, but still allow them to provide the relevant level of assurance they need to.
Absolutely, I think that's right, Mark. And just to kind of follow on, anyone who's kind of watching this, if you've not got a defined owner to the response of this within the business, that would be the first advice I had, is go and talk to people within your company, define somebody who's ultimately responsible for this process, and put people around them. And in different companies, it's different people. Some people we speak to, it's the head of internal controls or the head of enterprise risk management, whoever that is. It's in many businesses, it's actually the company secretary is the one that's kind of managing that overall response and steering from above. So that would be my first piece of advice, is to go and define who those people are, who has a stake in all of this, get the executive input that you need, and then build from there. And don't wait too long, which I think is the next question anyway, Mark.
Well, so, sorry, can we just pick up
Sorry,
on
Richard,
Sure.
I mean, there was a lot of talk about introduction of a SOX light process or approach, and maybe this is SOX light, but I think it's so light it'll just disappear in a puff of wind. And I think I would also say, don't forget to engage with the chair of the chair of the audit committee, chair of the risk committee, if there is one, and if there isn't, why isn't there? Make sure that because at the end of the day, it's those people who are going to be signing off on this, and unless there's a sense of this is really important to us, guys, it won't get the attention in the boardroom that it needs. And whilst we don't want boardrooms to be merely there to keep corporate governance on the tram rails, it is an important part of our responsibility as board directors. I did just want to touch on two other, what I think are important changes. Well, one's important and one's amusing. The remuneration reporting is going to have to report more explicitly on malus and clawback arrangements for bonuses. I've long argued that corporate governance will never be taken seriously until there is a personal risk sitting somewhere in the boardroom. And that risk is beginning to sit there, and you kind of suspect that malice and clawback, of course, it's not going to happen to the independent NEDs because they don't get any bonuses, nor are they allowed to be paid in shares. But that is bringing it right into the boardroom, which is really important. The last change that I was intrigued on was intrigued by was a bit of kite flying by the FRC when they said, "Anybody got any thoughts on AI?" Let's hope that not too much of the reporting on internal control is carried out using Meta's AI model, which was described, I think it was yesterday or the day before, as being dumb. Artificial stupidity instead of artificial intelligence. So back to you, Mark.
Yeah, no problem at all. So, and I think before you talked about those last couple of revisions, you touched upon, started to touch upon my next question, Richard, which is, because we talked now about what changes are being proposed, but the obvious next question is who will be impacted by these changes, and what are the likely timelines? Who would like to take this one on first?
I'm happy to give the first point. It's quite binary, so I'm sure everyone's been reading up on it anyway, but the 750 rule of turnover and employees, 750 employees, but also the timeline. So I think the latest update from last month was on or after the 1st of January, so whenever your reporting window opens up within that year, is when you'll be expected to report from. So it feels like there's a lot of time, but I promise you there's not that much time, especially if you're one of those organizations that doesn't already have that culture within it around broader risk and compliance culture. So please do start engaging with people early on. Through FY24 is when a lot of our customers and the people we're speaking to at the moment right now is when they're kind of setting up everything up and setting out the stall to kind of use that first initial year as that trial run for Comply or Explain, and then starting in earnest through 25. Have I got the understanding right, Richard?
Yes, you have. It's the years beginning on or after the 1st of January 2025. So there'll be an awful lot of people who've got years that end 52 weeks ending on, I don't know, 30th of December will think they've got an extra year's grace. I have a slightly cynical view, which is, who will this impact? Well, this will impact companies that take corporate governance seriously and who are therefore less likely to get involved in the malarkey that we see in the wall of shame of big corporate failures. The ones who are less likely to be impacted are those who don't take it seriously. And we know perfectly well that the next 2 or 3 corporate governance disasters are already being incubated. I don't know who they are, but we do know that they're being incubated, and they will happen sometime in the next 2 or 3 years. So those guys aren't going to take it seriously at all. And of course, those are the ones who should be forced to take it seriously. So that's a slightly cynical perspective on the benefit of this. Good people are doing it anyway.
Yeah. You mentioned earlier, Richard, also about the listing rules, and obviously that has an impact on who has to follow the code. I did see that the Financial Conduct Authority issued a consultation on primary market effectiveness back in May. So along with other things, it proposed a move from the standard and premium listing to a single category for listed companies. So this means that more companies then would potentially be drawn in and required by the listing rules to follow the code. So it'd be a standard thing as part of the listing, rather than if you're just a primary listed organization. So, the proposals do have the potential to increase the number of companies who use the code to drive high quality corporate governance and its reporting and improve market confidence. Obviously, how seriously they take it is a different matter entirely. And you've always got that comply or explain approach to all of these things. But yeah, it's interesting to know that people might be forced to be brought into it at least. And then it's about how seriously they take it. But that again brings me on to my next question, and I think it's probably the most important one. Is do we think these proposed changes will drive positive change regarding the management of risk and internal controls within UK companies? So we all obviously want to be optimistic, hope that the answer is yes, but there also needs to be a dose of realism applied. Senior management performing key governance roles within these functions are responsible for managing risk and internal controls across 3 lines of defence. For their own preparation, expectation, nothing else. They need to know if changes are coming, so that they can prepare accordingly. So when I say changes are coming that their board are going to take seriously enough that they want them to act and take action and prepare, like we've just talked about the timelines, in a relatively short space of time, depending on where they are on the kind of maturity curve as it stands at the moment. So I think it's pretty clear to most people regarding the business case for internal controls and the role that they play in managing risk and providing reasonable assurance over a company's reporting, disclosures, etc. But without that regulatory stick being waved around to provide that added encouragement to do the right thing, then we are leaving it in the hands of board members to make that decision for themselves. And then it really comes down to individuals, their attitude towards risk and controls, and the kind of culture that they develop within an organization. So the cynical part of me is a little bit concerned, but the optimistic part is keeping faith at the moment, but only time will tell, I guess. So let's perhaps come to you first, Chris. What are you seeing out there during your discussions with customers, and do you think changes like those being proposed by the FRC alongside the draft legislation will be a sufficient catalyst for change?
I think you've kind of hit the nail on the head with your kind of summary there, Mark. And we all wish there was more teeth. I think everyone but the dodgy directors wish there was more teeth. It's what we want is for this not to just be a checklist of things for which we now comply with, but rather a platform from which to actually stir more conversation around what is good governance and why should it only apply to certain businesses. And I think that's kind of critical. From the conversations that I've been having and we as a team have been having, those that are taking it seriously are really taking it seriously, and it's really, really good to see. But there are those who are looking for an easy way out around this and are happy to do the bare minimum. And at that point, the reforms themselves aren't going to achieve much, because there's a bigger issue at play there, and that issue is around the compliance culture that you have within your organization. And nothing, unless there is a particularly large stick and there is proper legislation around this, like a US style regime, you're unfortunately going to be pushing water uphill if you're one of those management within a business who really wants to do the right thing, but you cannot get the seniors and stakeholders excited about it or involved in it, or indeed worried about it. You're probably going to be in a really, really tough spot. And that speaks to, as I say, something far, far bigger and more worrying, which is when a company or a business doesn't actually care around corporate governance and just wants to do the bare minimum. Mm-hmm. That's the most dangerous thing. Mm-hmm. And it's surprising, actually, how many of those there are.
And I know, based on previous conversations we've had, Richard, you've got your own strong thoughts on this as well.
Yeah, well, I think I've already expressed my cynicism.
Mm.
I think there are far too many. I mean, Sam Bankman-Fried didn't have to comply with the US equivalents, but actually, I should probably call him Sam Bankman jailed soon. I think there are too many SBFs, Sam Bankman-Frieds, sitting around in corporates in the UK who take a freeloading advantage of the fact that the vast majority of people take this reasonably seriously. I can't think that this will make a jot or tittle of difference to those who already take it seriously. I've since the global financial crisis, when I wrote a paper on comparative corporate governance and risk management in UK, US, and France for the OECD, I've taken the view that we should really have a very simple corporate governance act in the UK, essentially one clause which says that unless directors need to be able to demonstrate that they have discharged their corporate governance responsibilities with due and diligent care, otherwise they can be banged up. Now, unfortunately, the FRC, their primary stakeholders in all of this are chairs of large FTSE companies, and there ain't one turkey who's going to vote for that proposal. So I think it's highly unlikely to happen. But that said, at the moment, we already financial organizations that are regulated by the PRA but aren't listed are likely to have to comply with something like the corporate governance code, maybe the Bank of England's own governance code, but it'll be very similar, and they can be disbarred for not doing so. So you may see pockets of compliance and positive action, but I'm very skeptical about whether it will pick up those 2 or 3 organisations where I contend they're already incubating the next corporate governance failures to be added to the wall of shame.
Mm-hmm. Yeah, some interesting thoughts, and I think only time will tell, I guess, whether that plays out as we expect or not. Maybe it might surprise us. But my next question then, despite some clear and obvious reservations about these revisions being a guaranteed driver for change, which I completely understand, and I think other people listening will understand that as well. I need you both to visualize your pint glass as being half full rather than half empty at this point. My next question is, what steps should organizations take to ensure compliance with the revised UK Corporate Governance Code? Now, obviously, the cynical sides of us would respond saying, well, you don't need to do anything because it won't change a thing and nobody cares anyway. However, let's approach this in the spirit in which the code and its revisions are intended, which is to raise corporate governance standards so as to generate greater trust and confidence in UK companies without being overly prescriptive about the way in which you have to do it, and being able to apply those things like proportionality, flexibility, while still achieving the underlying principles. So let's perhaps come to you first, Chris. What do you see as the key steps organizations need to take?
The first thing for me is as I mentioned earlier on in the conversation, is getting the right people in a room to actually have an open and honest discussion about where you are as a business and why these things matter. And part of this is kind of winning the hearts and minds, and it kind of speaks to all the other points we've spoken to already in today's session, is that it can feel a little bit negative, but certainly anyone who's joined this call clearly cares about this stuff. Anybody who's kind of engaging in the conversation cares about it, and they should, because this is not a trivial topic. These are the type of failures that can ultimately bring a whole company down and put people out of work in one of our economic crises, which is where we are today, which is why these things are so important. Mm-hmm. And you have to kind of, for me, finding the champions of that within an organization, whichever bucket of risk control compliance they already sit in, whichever senior leaders you can get on board, get all of those people together, have an open and frank conversation, and fundamentally create a map to said compliance. Mm-hmm. What steps should they take to kind of ensure it? is organizational specific in so many ways. But it's absolutely something that requires conversation with all of the people who have a stranglehold or a stakehold within this.
Yeah, I think it's definitely organizational specific, because from my perspective, what steps an organization needs to take will depend upon where they are currently. And when working with customers, we quite often start by understanding where they currently reside on that kind of risk and controls maturity curve, as well as what level of maturity they want to get to, importantly, so that we can work out the required activities to help them achieve their goals and objectives. So if you take a look at any maturity curve, the first step will always focus on people and processes, not the technology. So the framework, content, and associated governance roles and processes, such as designing, documenting all your relevant internal controls across your core material business processes, identifying those risk and control owners, defining required controls assurance activity, etc. All these things will be relevant to these revisions in the code regarding risk and internal control frameworks. So you need to be confident that these systems of control are working and be able to demonstrate their effectiveness across the entire reporting period. As you mentioned, Richard, it's not about point in time. It's done to be done every year, but also importantly, they need to demonstrate that these things have been working across the period that you're reporting on, i.e. the whole kind of financial year, not just at that point in time. But so it does, I think organizations need to work out where they are, what's the gap between where they are now and where they need to get to. But Richard, any thoughts from your side on this?
Two or three things. I mean, the first I've already mentioned is that I think you need to get the non-exec members of the board who are running audit and risk and other relevant committees on board. Second thing is, and whilst we don't necessarily in those positions have a budget, we can influence and ask for change or demand change. The second is that it needs a programmatic approach. It's not something that will happen by serendipity. So making sure that there is a program with senior sponsorship, senior leadership, and with a program to achieve compliance is really important. There was a third thing, but I can't remember what the third thing was, so we'll stick with two.
I guess there's a point that the shareholders, the stakeholders are going to demand some of these things as well. And I know there's mention in the code about the heads of the audit committees and those sorts of parts of the business with that influence and the responsibility for assurance to engage more with stakeholders and shareholders to understand what their views are and what they would like to see inputted as well, so they can gain greater confidence. Sorry, Richard.
The third thing I was going to talk about was the need for assurance, and the proposed changes to the draft are very, very non-specific about that, but it will need appropriate assurance, whether it's internal audit or external support. It's not going to happen just because the CEO and the CFO told me it's happening doesn't necessarily mean it's happening. So we need to make sure that there is that broader assurance program around it.
Absolutely.
I knew there were three things.
Okay, so my last question is closely related to the previous one, as it definitely should be one of the steps taken to address the requirements of the code, even if it's not the starting point, which it definitely isn't. So my question is, what role can and should technology play to ensure compliance? So let me come straight to you on this one, Chris, to get your thoughts and also what you've seen from a technology enablement perspective with some of your customers.
Yeah, no problem at all. So the first thing I would say is that technology in itself does not get anybody compliant with this stuff. It's not a silver bullet. It's not something that you can buy, forget, and kind of leave there. Rather, it's a vehicle from which you can build the risk and compliance cultures that we've been talking about throughout today's session. It breaks down the silos that probably exist. Certainly if you're one of those businesses that is a little bit more complex or historically siloed, it will help break some of that stuff down and get people talking in the same language from a single source of truth. As Mark said, it's not right for every organization in every situation. It's something that should be brought in kind of at that level 2 stage, shall we say, on a maturity curve. So that level 2 might be, and Mark will have an opinion from the customers he worked with as well, might be having your Rackhams built out, might be having a second line assurance function that's actually going and doing some work, having a level of first line self attestation and self-assessment already existing within the organization. Typically that stuff is all spreadsheet based, followed by Microsoft forms that go out. When that maturity is getting to the level of, okay, we've kind of got a handle on this stuff now, but it's getting harder with more data. It's getting harder to go and cover new entities through this process. That's when technology can really come in and start taking some of that heavy lifting. The other element, ironically, that we see as well with some customers is if you're a pretty small team in a pretty big business, and you think, oh, there's only a handful of us, we can manage this. Technology, again, is something that can help kind of fill the void of team members that you probably should have. And I've had this with multiple customers who are struggling to get executive buy-in for more auditors or for more internal controls professionals. They're struggling to kind of get a handle on that. So actually, it might be easy to get less budget for a piece of technology that can automate that can automate some of the heavy lifting that may have been done by those extra team members. Some organizations go big and end up with this massive team to the point where technology actually doesn't kind of make sense for them because they've got too many people and there's too many kind of roles and responsibilities out there. But getting something in to connect to source systems, automate tests, all of that type of stuff is completely achievable today. And it's not something that too many businesses have kind of taken advantage of yet. So if you're one of those kind of businesses that you see complexity, you're kind of a glorified admin in kind of some ways, and you don't feel like you're adding the value, then technology is perhaps a conversation that you should be looking to consider. That's certainly my take on it. And not all technology is right for all businesses. I would strongly encourage you to go and find that right fit about what works for you. But yeah, that's kind of my take on it. The only other bit is, talking specifically around corporate governance and the code changes and that director's statement around the continued effectiveness of internal controls. That's where technology kind of starts coming into its element, because that can be quite an onerous operational level task as well as quite an onerous executive level task if there isn't the trust that's built between the two. So being able to surf information in a repeatable, trustworthy format with the right narratives and context around the state of your controls and risk stature within the business. Once you've kind of achieved that, then you start taking away some of the distrust and you start giving the power to the executives to actually make that statement with confidence and with assurance around what they're doing. That's much easier to achieve with source data than it is PowerPoints flying between various different teams and hours spent kind of creating the information that the board needs. So that's kind of my take on it. As I say, not right for everybody, but absolutely something that should be considered if your maturity is starting to get to that point of not really sure where to take the program from here.
Yeah, and I couldn't agree with you more. I think if UK companies want to take corporate governance seriously and do things the right way, then yeah, technology is a really important part of that. It's, as we've stressed before, it's not the first stage, certainly. It's about getting the content, the people and the processes in place as well, or at least alongside it. But that without the technology being introduced, you can't progress beyond those initial stages of the maturity curve. It's just impossible to provide that required visibility and transparency over your internal controls and the way you're managing risk without it, really, because of the data is just locked up in so many different systems. It's complex, and so to tap into that, you need technology to support you in that process. I'm just mindful of time. We have got one question coming through the Q&A, so let's address that now. So the question is, with the FRC budget being extended to the end of 2024, and the lack of reference to these changes in the new business department priorities, does the panel think that any of the changes will ever happen? Question mark. The UK still is a comply or explain, and without FRC having any powers to go after companies, as they do not have the power to prosecute, when will change occur? Richard, any thoughts on this?
This is a delegated responsibility to the FRC, and presumably it will transfer across to ARGA in the fullness of time. So I don't think it needs reference in the business department priorities. The FRC is perfectly able to push the changes through to the corporate governance code. Your second point, I couldn't agree more with you, Julianne, and I think I've addressed that. We need a simple corporate governance act that forces some degree of compliance. Totally agree.
Anything further to add, Chris, from your side?
No, I think Richard and I are on, and yourself, Mark, on the same page around this. More teeth is better, and I think it's all in the fullness of time will we start seeing the UK really pressing forward like the way some of the advanced economies have.
Great.
Well, there aren't that many that have pushed forward with punitive responsibilities. Most of the EU codes very much follow the old the UK approach. That may diverge over time. The only one with a real punitive approach is the Sarbox. So we'll see.
Absolutely.
Thank you for the closing comments, and thanks, Julianne, for that question. Unfortunately, we've run out of time for now, so we'll have to close the webinar at this point. I'm pleased to say that you'll be able to access the webinar on demand shortly via our website, so keep an eye out for that. And if you'd like to discuss any of the content covered today in some further detail, then again, please don't hesitate to reach out. Thanks very much again, Richard, Chris, for your contributions to this discussion, and for those attending and joining us on the live session today. Enjoy the rest of your day, and we'll see you soon on future Turnkey Key Insights. Thanks, everyone.
Thank you.
Thanks.